So with higher interest rates on the way, Britain's home buyers are looking to take advantage of low mortgage costs while they still can. The latest survey from the Royal Institution of Chartered Surveyors shows another improvement in UK housing market conditions. More real estate agents reported price gains last month, fewer reported declines, but I should point out that the overall trend still down, as 32% of those surveyed still say prices are falling. And RICS warns that the market will soon feel the impact of higher rates and government spending cuts. So, want to get into this now with RICS chief economist Simon Rubinsohn. He's in the studio with me. So, this specific survey shows, what does it tell us about the recovery in the UK housing market? It's continuing.
Well, it's a slow but steady recovery. Clearly, there are very strong regional disparities. The London market is looking particularly resilient. It's underpinned by increasing levels of activity. If you look at other parts of the country, activity is a bit weaker and the price trend is still a bit softer.
Can we expect that divide to continue, if not worsen, during the course of the year? I mean, would you say that London prices will continue to rise, will get even more stronger, even more buoyant?
Well, there's no doubt that London at the moment is also benefiting from some sort of potential, some purchasers looking to take advantage of current stamp duty rates. We know that the stamp duty rate on properties worth £1 million and more going up from April. So there is a bit of a rush there to take advantage of, and that I think is perhaps squeezing prices up short term.
Now in April than we will for expensive London houses post-April.
Post-April, we may see that tail off a bit, but I think you also got to remember that the London market's being driven by two really key important factors. One is still overseas interest. It's a safe haven. Turmoil in the Middle East, London is a beneficiary of all of that, or the London housing market is, I should say, because there's just more money flowing into sort of what are perceived to be safe havens, and the capital's prime property sector is seen to be one of those. Secondly, the sort of recovery that we're seeing in the whole professional services, financial services industry, there are a lot of problems still overhanging the banks. We know about those, but we can also see the benefits of the recovery coming through in that sector. That is also helping to underpin London, and will continue to do so.
It'll continue to do so.
Absolutely.
So possible the risk of regulation on banks, on financial institutions, isn't going to impact on London house prices anytime soon.
Well, I mean, look, there are always risks, and we know we read stories about HSBC thinking about where it wants to be headquartered. Obviously, in the medium term, there are some issues here which could come back, to undermine the market, arguably. But I think looking over the next year or two, it looks to be pretty well underpinned by the fundamentals.
But 32% of those surveyed said prices are still falling. What the overall trend is down.
There's no doubt that if you're looking across the whole country, there's still more of our members are reporting price declines than price rises. But actually, the majority are actually saying prices haven't changed. And of those who are saying prices are falling, most of them are saying they're falling fairly marginally in that 0 to 2% bracket that we have, rather than anything more meaningful. So even across the rest of the country, it's a gentle.
So the overall picture is mixed.
It's pretty. I'd say if you're characterising it, it's a pretty steady picture, slightly down on pricing out of London, slightly up in London.
And you said that there's a bit of a rush, people trying to get in their houses worth $1 million and plus, reduction in stamp duty, and that incentive is going to run out come April. What about the prospect of a rate hike in the next few months?
I think a rate hike is clearly something that will impact on sentiment. Let's remember that a lot of mortgage rates have already begun to go up, so people who are actually borrowing are finding that the cost of finance is rising. That's happening. That being sort of effectively underwritten by a move in the official interest rate probably will have a marginal impact, but on its own, not, I think, one that will undermine any prospects for a more stable market going forward. Obviously, it depends about obviously, the key thing is how far interest rates go up. If we're talking about sort of 0.5% sort of to 1% area, I think the market can weather that. If we start talking about
1.25%,
I think 1.25% is something that wouldn't undermine the market at the present time. But if we look about, if you start to worry about whether inflation really is coming back towards target next year, and we start talking about perhaps 3 or 4% interest rates, that's a very different sort of scenario.
Great to talk to you. Thanks for coming in again, Simon Rubinsohn of the Royal Institute Chartered Surveyors.